Here is part 4 of module 3, which is the final part. Congratulations for making it this far. We will now explain the time range high probability filter, which is one of the very important filters that you need to make before you take a trade. Now, this is a filter to even further enhance the probability of your trade. In a gist, the high probability trades are those where the stock's price has retraced, whereby it has made a pullback to at least the 50% mark in a span of about at least a range of a minimum of after 1 to 2 months. Now it sounds very like difficult and there's rocket science, but let me just continue first and I will give some examples to explain it further. And the highest probability trades are those where the stock's price has retraced to at least the 61.8% to 78.6% or more mark in a span of about at least a range of a minimum of after 1 to 2 months. Again, it's like rocket science, but let's go through a few examples with the concept right now. So what you see on the chart here is a chart of Goldman Sachs. Okay, so you can see that, let me bring out my pen tool over here. Okay, you can see that price has made a move up and then retraced. Okay, so this is what you're looking for. Let me bring up my notepad. So what you're looking for is a price move up and then come back down, which is a pullback. Okay, a pullback to at least the 50% mark. Alright, so which means that if this is $1 and it went up to $2 as a hypothetical example, and it comes back down to half of this range, which is 150, then the criteria will have been fulfilled. Alright, this is the most basic pattern, but it has time range filter in a sense that you need for this to happen, you need to see whether this phenomenon has happened after, after a period of at least 1 to 2 months. Alright, which means that the range from here to here in time should be at least after 1 month. The more the merrier, okay, but at the minimum I would prefer a 1 month time period for this to happen. Okay, let's go back to the Goldman Sachs example. So you can see here the date for this particular area over here. Okay, this bar is the 16th of December 2014. Alright, after that it made a move upwards. Let me change it to a brighter color for you. Okay, it moved up and then start to retrace. Okay, let me remove my moving averages at the same time so you can see properly. Alright, so from here it made a move up and then retraced, and you can see that it has reached the 50% mark, alright, which fulfills the criteria. However, has it fulfilled the time range filter? So let's do a check. This is 16th of December, so 1 month exactly would be the 16th of January. Alright, so 16th of January would be here instead, okay, on this bar. Alright, so even though the stock retraced 50% here, because it did not hit the time range of at least 1 month, any setup, which is the setup here, you can see Stochastics RSI has issued a buy signal over here. Okay, over here. You cannot take this trade because it did not pass the filter of a 50% retracement only after 1 month. So after the 1 month period, which is from here to here, which is essentially this range, you will check whether there's at least a retracement of 50%. In this case, it has retraced far more than 50%. Alright, so the criteria has been fulfilled. As long as more than 50%, you are able to take the trade. Okay, so let me erase all this. So your end point, instead of entering here, you'll be entering somewhere around here instead. Okay, because you're only taking the signal after it has fulfilled the criteria. So the buy signal, the second buy signal actually came from here. Okay, which is you're supposed to buy on this particular bar here. However, like I said in a previous video, unless you are very aggressive, you can see there's two big price bar up. Okay, so you should wait for a 50% retracement. So once it has retraced 50%, buy around here, put a stop below here. Okay, this one is entirely up to you whether you want to wait for 50% retracement, but generally, given such a big 2-bar move over here, I will wait for a 50% retracement. So buying here and a stop below here, you can see that price started to move up more, and the stochastic RSI has been overbought for a period of time, and the only time it actually came downwards here is somewhere around this point. So you can see it made you close to a 3-to-1 risk to reward reward to risk profits. Okay, so this is the first example. Let me go through another example to illustrate my point. Let me remove the moving averages for clarity. Okay, so this is a chart of Coke. Similarly, you can see that price has moved from a bottom here all the way up and then retraced. So we will see where does the 1 month mark actually appears. So on this area, you can see that the date is on the 16th of June. Okay, so 1 month after that would be 16th of July. So you will forward to 16th of July, which is actually this bar over here. 16th of July is somewhere around here. Okay, and the question is, has it retraced 50%? Has it pulled back 50%? The answer is no. Alright, because if you were to just draw a retracement over here, the 50% mark is actually somewhere around here instead. Okay, this line that I've drawn over here. Alright, so because it did not hit, any trades on the stochastic RSI will not be taken. Okay, so you have avoided this trade, and after that you can see that on this bar, it has retraced more than 50%. Alright, the 50% mark is actually here. Okay, it's actually here. So you can see on this bar it has retraced 50%. So it has fulfilled the criteria. After 1 month, the stock has retraced at least to the 50% mark on this particular bar itself. So what do we do now? We wait for a trade on the stochastic RSI. Okay, so the stochastic RSI is here, and you can see that it is in a oversold position over this period of time. So you have to be patient and wait for it to pop back up, which is right over here. So the bar that when it popped back up was actually this particular green bar over here. So your entry price will be here with a stop below here. Alright, if you feel that the bar is too much and you want to wait for a 50% strike, you can do so, as I stated in my previous videos. Alright, and then you will trade it upwards all the way. Okay, until there's a sell signal over here, which coincides to this point. So you may or may not get a 2-to-1 here, okay, but I think you should have. Alright, so it really depends on your risk, your comfort with risk. Okay, some of my students like to, once they make 1:1, they will take half of the position and put a stop to break even. Okay, but it's entirely up to you. For me, let me repeat what I like to do. What I like to do is to, let's say, buy over this point, and my risk is here. I'm just repeating the concepts that I've done before, but a little revision doesn't hurt. So once it has moved 2 to 1, which is around here, that means price has moved 2 to 1 over here, I will take off 3/4 of my position and move my stop to break even over here, and then I'll write my remaining position as high as I can. Alright, but you can choose to do it in a different manner that suits your personality. Alright, because if you are very risk averse, you may not be able to hold the move until a 2 to 1 reward to risk ratio, and that's fine. But however, it is important to note that because you are doing some sort of a trend trading concept, you need to at least let a remaining part of your position to ride it to a much higher price. Because if you, let's say, take away 3/4 of your position and you're left with 1/4, then generally you will not have much stress at all holding the remaining 1/4 of the position. Alright, but try to adapt it to the way that you prefer to trade, and most of all, be consistent in your approach. Alright, so some people may ask, isn't this the Fibonacci approach or something like that? And it is a little bit somewhat, but and again, it's not really it at the same time, because it is just as simple as waiting for prices to, hit those retracement points first over a period of time before taking the trade trigger to dramatically increase the odds of your trade working out. However, I have to state that this rule is a general guideline, but you will be amazed by the amount of trades it can help to filter out for you. What is the reason behind this? I have no idea, except for the reason that it works based on my years of experience trading the markets. Alright, please note that we are talking about this particular filter on the mid to large cap stocks and not the really smaller cap control stocks. Of course, if the particular nature of the stock is a momentum stock, for example, like Apple and Tesla, right? Everything is, although the concept is very clear cut, but however, there's always exceptions to the rule in stocks trading. You can see that even though Apple or Tesla and those Facebook and high momentum stocks, even though they have a very high market capitalization, they tend to still trend very well. Okay, for example, if I were to show you Apple over here, you can see that even though it's such a big stock, the stock can actually still trend pretty nicely without significant big retracements. Alright, although it happens once in a while. Okay, so if the nature of the stock is very, very there's a lot of momentum in the particular stock you're trading, then of course this filter, you do not have to apply it. Alright, it depends on what you're trading. Okay, but unless you know for a fact that it is very trendy and has a lot of momentum, you will always apply this filter. Okay, you have to use some discretion in your very own eyes to discern the nature of the particular stock. Just like when you're hunting for animals, right? You need to know what kind of animal you're hunting to adapt the tools required or not required for the particular animal. Like what Anthony Robbins has said before, why would you use a cannon on a rabbit? Correct? Because it's probably too much of an overkill and would be counterproductive instead. As a disclaimer, I love animals. Okay, it's just an example to illustrate my point. To move on, let me give you a few more examples. This is a chart of IBM. Similarly, I'll remove this. Alright, so you can see the arrows I've laid out for you guys for easy viewing. Stock went from here, went up, and start to retrace. And the 50% mark is somewhere around this area. Okay, but you can see from here the date is on the 29th of August. So 1 month after that would be on the September 29. So September 29 would be actually here. Okay, so once this bar, which is the 29th, you can see that the stock has retraced 50%. Alright, so you're good to go. But what do you wait for? You wait for you wait for what you call a stochastic RSI buy signal, okay, over here. So the buy signal appears here, you will buy here, okay, and trade it upwards. Alright, in this case, it gapped down because of earnings, as usual. Later, in the later modules, I will... Oh, that's a bad drawing. Let me redraw it again. Okay, this is due to earnings. Okay, in the later modules, I'll describe when should you, take a look at earnings and how to avoid them. Okay, this is just an example of how it is supposed to work. So let's show you another example from here, which is 171, 172. Alright, it moved upwards and then start to retrace. So the 50% mark is somewhere around here. The date for this at the bottom was about the 13th of December. So 1 month later is 13th of January. So 13th of January would be... Sorry, let me see. Yep, 13th of Jan would be right over here. Okay, you'll be on this bar instead. Okay, but has it retraced 50% from here to here? The answer is no, because it's definitely not 50%, yet 50% is this dotted line area. Okay, so what do? You wait for prices to hit this area first, which it managed to fulfill here. So from here onwards, you are able to prepare and look for a trade. So the trade comes only when it's about here, okay, because it's oversold this whole time, and it only popped back up over 30 over here. Alright, so the buy price would be here, and your stop would be here. After that, you can see the stochastics RSI went up into an overbought region, and you will remain in the trade until it crosses below the 70 region. So you will just see how it works out over here. Alright, so stochastics RSI issued a sell signal over here, which is somewhere around here. So your entry price here with a stop here, you have made about a 2-to-1 in this trade. Let's show you another example to solidify the concept. This is General Electric. Let me remove the moving averages. Alright, so you can see a move here, very nice move up here, and then a retracement. So 50% will be somewhere around here. Now it's very obvious that the time required for this to happen has not been fulfilled over this region. Even though it has hit the 50% retracement, it has not hit the 1 month mark yet. So on this particular date, it was on the 17th of December. So 1 month after that would be the 17th of January 2015. So 17th of Jan is actually right over here. Okay, right over here. And it's very obvious from this point onwards that the stock has retraced more than 50%, because the 50% mark was here. So which fulfills our criteria. Okay, and we will take a buy here, put a stop over here, and then trade it upwards. Okay, in this case you probably wouldn't take profit over here, because like I said before, your reward to risk is not there yet, so you need to wait for the next cycle, and the next cycle happen over here, and your exit price will only be here. Of course, in between, how you want to manage your partial profit takings is up to you. Alright, but let's say if you were to hold on to the entire position, it will be 1, 2, 3, about 3.2 times your risk, okay, which is a fantastic trade. So we have come to the end of module 3. As there are several pretty heavy concepts throughout the module that were being taught to you and discussed, please take the time to repeat and go through them again several times to make sure that you have really grasped the concepts that are being put forward to you. In the next module, we will have a discussion on risk control and profit taking.